My name is Bill Megginson. I'm a professor at the University of Oklahoma. It's my day job, Price Chair in Finance. I'm also have a chair at Saudi Aramco Chair Professor in KFUPM, King Fahd University of Petroleum and Minerals in Saudi Arabia. And also then in the summers, I'm scientific advisor and editor for the Privatization Barometer. For the last 30 years, I've been a professor. For most of that, I've studied state ownership, sovereign wealth funds, privatization. So this has been a theme of my entire career. What we'll talk about today is sovereign wealth funds. And Gerard mentioned being able to write a paper, and sometimes it takes 5 years. Well, the paper that I'll reference at the end of my talk was actually, it finally was published in the Review of Financial Studies last year. After 6 years, 6 rounds, the first version was 2008. So 5 years would be nice in some cases. So what we'll talk about sovereign wealth funds, define what they are, how they're funded, how they invest, how big they are, what caused them to become so prominent so quickly, and what are they doing now, and what does the future hold for them. I'll look at research. It's stated as a survey of research. What I'll really show you mostly are the patterns of actual sovereign wealth fund investment and point to some of the research. I guess I can do this down here. So I'll walk around. I'm a professor, so I like to walk around and see him. So I've got my professor's voice. I could probably do without a microphone. Really the main topic I'll be talking about in terms of empirical research is our own. Of course, this is what professors do. We'll talk about most of the published research in finance has been on, I'm sorry, I'm causing you problems, sorry. Okay, we'll talk about the impact of sovereign wealth funds on corporations. I'm a finance professor, specifically corporate finance, so this is what we've been looking at. And finally, we'll talk about what have we learned from all this research, what are some of the unresolved issues, what are some of the trends. So let me go back up here, and we'll do it this way. I can make this work. So what are sovereign wealth funds, how are they funded, and how much, oh, there we go. Well, I can do this, since I don't have it coming out individually. As was mentioned, the term sovereign wealth fund, we know it, it's part of the lexicon now. It's only 11 years old. I wish I had thought of this, but Andrew Razanov came up with this marvelous term in 2005, sovereign wealth funds. They had this barbaric term before that. And it's now become part of the lexicon, and these have become very, very important. What are they? Yes. Oh, I'm sorry, I need to do the, okay. I worked for the Italian government for 5 years on their privatization committee, so I start talking with my hands, but I'll try to minimize that. So sovereign wealth funds can be defined in a number of ways. Sovereign wealth, as I'll show on the next slide, can really be defined in a number of ways. It can be fairly defined very broadly as a pool of government-owned or controlled assets that include some international assets. By that definition, sovereign wealth, the ownership of governments of financial assets, is something between $30 and $35 trillion. It's absolutely enormous. Or it can be defined a bit more narrowly as state-owned investment funds, which is how the Sovereign Wealth Fund Institute, by that definition, they total about $7.5 trillion as of this month. We also, I've been working at the Sovereign Investment Laboratory. I'll use the data in their definition, a bit more restrictive, which I'll show in a minute. And by that, it's 5 3/4. However, between 5.5, 7.5 trillion, depending on the definition, these are big pool of assets. Okay, so this is a bit of a spectrum of sovereign ownership, and I won't go through too much of it, but very quickly, the far left, you'll have official reserves the governments hold to meet their needs, their foreign exchange and the transactions needs. That's about 12 trillion. I'll show this in a minute. So that's the least risk. These are treasury bonds, gold, very liquid, very low risk, but also low return assets. The next one would be stabilization funds. My own state of Oklahoma is an oil state, so we have a stabilization fund for when oil prices decline. Many countries have this as well. These, again, are somewhat, they're not completely risk-free, but they need to be liquid, they need to be available when needed. Pension funds, again, are low risk, but taking on a little bit more risk, some equity. Sovereign wealth comes in the middle there. It's really the defining features. They seek a commercial return. They're willing to take some risk. They invest in equity, they invest internationally. Then the last two, development funds, much riskier, but mostly domestically focused, and then state-owned enterprises, which are basically state-owned businesses, just with the same level of business, same level of risk as any other type of business. So the definition that we'll use for sovereign wealth fund is that it's an investment fund, not an operating company. So these are not state-owned enterprises, although I was, we had the discussion this morning that Temasek may be a state-owned enterprise, but in general, they're investment funds, not operating companies. Second, they're wholly owned by a government, a sovereign government, but this is what keeps Alaska, by the way. It's a sovereign government as opposed to in the Canadian regional, don't make our list because of this. But they're separate, politically, operationally, to give them some independence from the government. They're usually not run by the central bank or by the Ministry of Finance. They're separately incorporated, separately organized. Third, they make international and domestic investment, including risky assets. This is one of the defining features. Number four is actually probably the defining characteristic. They seek a commercial return. So they're actually investing in search of a commercial return, including equities, including risky assets. And finally, they're a wealth fund rather than a pension fund. Nobody's name is on the liability stream. They're a wealth fund for the country, not individually. I have investment in TIA Craft in the United States. It's got my name on it. It's a pension fund. This is a wealth fund for the government. So although this seems clear, what you'll quickly find is that the United Arab Emirates are the largest collectively, or with China are the largest, but they basically, these are organized at the Emirati level. Sovereign, with the exception of UAE. 2/3 of all these sovereign wealth funds by assets are funded by oil exports. 2/3 have been started since 2000. Oh, there you go. I got one for each hand. We'll make this work. You see here this is the ranking of sovereign wealth funds, and usually the number one is the Norwegian fund, Norwegian government pension fund global, GFCF. GFF, I shouldn't even try. GPFG. This is the class of the league. This is by far the most transparent, the most professional, one of the oldest, the largest, has a completely different investment philosophy than almost all the other big ones on there. Abu Dhabi Investment Authority is next. What's its assets? Who knows? Could be 500 billion, could be $1 trillion. Best estimate by the Sovereign Wealth Fund Institute is 773 billion. I've had private information that it's closer to $1 trillion. But again, they don't disclose. Even the most basic, they don't disclose what the assets under management are. Then you can see down, China's next, this China's Investment Authority. There's several Chinese. Saudi Arabian Monetary Authority has now become a sovereign wealth fund. I work for Saudi Arabia, I work in Saudi Arabia for 2 months of the year, so this is always a special case. Kuwait Investment Authority, again, it's an estimate. They don't disclose their assets. That's the oldest. Kuwait Investment Authority was actually started in the 1950s. So you go down and you see that by our definition, $5.75 trillion of assets, 2/3 funded by oil exporting countries, 1/3 by others. Let's see if I can make this work. Nope, we'll do it the old-fashioned way. You can see that sovereign wealth fund assets have grown, and they grew very rapidly until 2014, and then they've leveled off. But they leveled off. They have not actually declined. So you've basically hit a stasis level, and they really haven't declined since then. Well, I'm not going to be able to have, I had cute blocks and circles that would show the key data, so I'll just have to point to that now. Again, they're very large, $6–7 trillion, but as a percentage of the total world assets, financial assets, it's 2 or 3%. Total global financial assets, the estimate is they're close to $294 trillion in 2014. So their sovereign wealth funds are big, but in terms of the grand scheme of things, they're a very small percentage of the total financial assets in the world. Okay, what caused the rise to prominence? Well, a couple of things, and really 2 things in particular. I hope this works. Let me see, I may have to, no, it's not going to work, so I'm going to have to do it the old-fashioned way. You can see this is foreign exchange reserves from 1984 to 2013. And it basically goes to from, in the 1990s, about 2 trillion for the whole world to 12 trillion. What happened? Well, those in this room probably know. 1997, 98, 99 were the East Asian financial crisis. Catastrophic event, largely caused, or at least promoted by, inadequate reserves. So countries around the world have said never again. We're just not going to have this happen. So there's been an accumulation of foreign exchange reserves, and you can just see it take off after 1999, 98, 99, and again, it hit 12 trillion. So you have $12 trillion in foreign exchange reserves, very low risk. They're basically sterile assets. They're not yielding anything. So the impulse has been, let's sweat these assets. Let's get some return from these assets over the ones that we don't actually need for liquidity. That was the #1 promoting factor. Close to home, I was a petroleum chemist in an earlier life. Looked at the petroleum industry for a long time. Up to 2002, it was basically $20 to $25 per barrel of petroleum. And then the world changed. You'd be in this very long upward rise, hit 147 in 2008, but even after the break here in the financial crisis, you're in a range of $100, $110 per barrel. Now again, over most of this period, the world produces and consumes about 90 million barrels of oil every day. You do the math. 90 million barrels per day times $100 per barrel times 365 days a year, roughly half of it exported. You're talking about capital flows in dollars of about $1.5 trillion per year. Excess capital flows for most countries that have small populations that can't use it. You had this massive accumulation of dollar-denominated reserves that needed to be put to work. How do you put them to work? You set up an investment funds to make global investments. Some 70 countries founded sovereign wealth funds, or tried to, after 2005. We document in the study, either this one or the one previously published, that over 25 countries proposed sovereign wealth funds just since 2008. It's uncanny. There'll be a major discovery. We found a large natural gas field. The next day, well, I'm exaggerating, but very soon, the legislature will propose a sovereign wealth fund to use these new assets, make sure that the wealth coming from this new discovery was channeled properly to the benefit of people, basically trying to keep it out of the hands of entrenched elites, state-owned enterprises. So this was a natural impulse. When a wealth was found, when a resource was found, to set up a sovereign wealth fund to make sure that it was managed appropriately, the wealth was used appropriately. Oops, sorry. So we were going along, everything was just wonderful until the world changed. And I should have a block here that would show it. But basically, after 2014, the middle of 2014, you had a drop, not a drop. You went from $110 a barrel to, at its low point earlier this year, $25 a barrel of oil. You do the math. Decline of $75 times 90 million barrels a day times 365 days a year. This is a huge change in global capital flows. So what happened in terms of sovereign wealth funds? Well, one of the first impulses, of course, one of the first impacts was you started to have a decline in foreign exchange reserves, the total holdings of reserves. For some countries, particularly the Gulf Cooperation Council, the Persian Gulf countries, it was 10%, I mean, it was very large. So the budget deficit in the Gulf countries is 10% of GDP. That's the debt, not 10% of government revenues, 10% of GDP. How do you make up 10% of GDP? This is the problem that's being faced by these countries, especially the ones in the Gulf. All right, so why did this cause so much alarm that sovereign wealth funds became big so quickly? Partly it's because they did become so big, so fast, they were state-owned, caused alarm. They accounted, we actually have it's not in here, but I have a slide in The Economist we were quoted that showed between 2000 and 2012, governments actually purchased more stock than they sold in privatizations. So this was a period where, on one hand, one group of governments were selling stock, privatizing. Another group of governments was actively buying stock. And again, one of the problems that has always been the case is these are mostly most of the large funds are non-democratic states. To see how it was originally focused, you have this was from early 2008. And I love this because this is how the sovereign wealth funds, the invasion of the sovereign wealth funds. And I have another key point here. Sung to the tune of Wagner's Ride of the Valkyries. The dun, 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 you have the helicopters coming in, the invasion, and they're dropping gold bullion on people. So this was how they were perceived, these alien force coming in, taking over all of our businesses. Okay, well again, they basically rescued Western banks in the financial crisis of 2008. So now they're viewed much more positively. Basically, they have the money, so they're always welcome. They also signed the Santiago Principles in 2008, which did some, not very much, but did some. So where are we now? Basically, these are the sovereign wealth fund holdings by country. And again, note, if you're a fan of democracy, which most of us in this room are going to be, this is not who you would want to see running the world, right? These are not, what Norway is, Singapore is, US, Australia. Other than that, these are not democratic societies. These are not democratic states. That's who's controlling the wealth of sovereign wealth funds. That I should have a slide. Basically, there's a lot of moving parts here, but if it's red, it means either that these countries are ranked low in economic freedom, they're very statist as opposed to market-oriented, or they have a very low corruption, well, a very high corruption index. So if it's red for both of these, Kuwait, Abu Dhabi, China, Russia, Qatar, these are non-democratic, non-open countries controlling the wealth. Only Norway, Singapore, and only one of the two Singapore are basically what we would call Western-oriented democratic societies. So it's not really the ideal situation of who would own the wealth if you're a fan of democracy. All right, this should come in 2 slides, but it's here now. You've probably heard that Saudi Arabia is planning a $2 or $3 trillion sovereign wealth fund with the proceeds of the Saudi Aramco IPO, which is probably going to be a $100 billion IPO, by far the largest share offering ever. And it's probably going to happen. So will that actually produce a $2 trillion sovereign wealth fund? Not a chance. They'll put the stock into the sovereign wealth fund, but as you can see from these two, the revenue from oil sales must go to the government. This is Saudi Arabia, 85% of government revenues are Aramco. There's no way you can sequester those reserves. They're going to have to support the government. So there's absolutely no chance, unless the world changes and we go back to $100 a barrel, that you're going to create a $2 trillion sovereign wealth fund. It'll have assets, but these are not assets that are going to yield. What Saudi Arabia will have is the existing financial assets, but even those are being drawn down very, very rapidly. $100 to $150 billion a year. Saudi Arabia is in serious financial trouble. Offline, if you're interested, we can talk about the IPO and my thoughts of what should be done, but it's not going to set up a sovereign wealth fund. So how do they select investments? How do sovereign wealth funds select investments? If you're interested, you can read through this or read the paper. Key point, we're academics. We look at this and we say, how should they invest? Given what we know about sovereign wealth funds, what should they do? All right. Well, some things are fairly obvious. If you're if you're an oil exporter, the last thing you should do is invest internationally in other oil exporters, right? So you don't buy oil. If it's a small country and it has a large earnings, you can't invest that domestically because you're going to have the mother of all asset bubbles. Brief digression. In 1998, I visited Norway, and they knew that I worked on privatization. So and it was just at the start of, they were producing $40 billion a year in revenue from the North Sea oil. And they asked me, what do you think we should do with $40 billion a year? And I consulted my co-author, Jeff Natter, and he came up with a classic example. With $40 billion a year, you should just go ahead and buy Russia. And, at that time, $40 billion would have gotten it for you. Political problems. But again, they could not possibly invest all that money in Norway. Abu Dhabi could not invest the money in Abu Dhabi. So it has to be invested abroad. Do you do it equity? Do you do it bonds? These are the kind of issues that academics have looked at. How should you structure this investment? And then at least 2 or 3 papers have looked at the Norway model. Let me briefly mention that. Norway is a classic foundation model. What does that mean? You basically, if you've worked on your school or church, you have a foundation, and it classically is 60% invested in stock, 30% in bonds, the other 10% cash and real estate. Fairly straightforward, been around for hundreds of years. Okay? The model, that's what Norway has used. The Yale model, which is what private US endowments have used, have been private equity, natural resources, illiquid assets, absolute return assets, non-traditional returns. And they've yielded quite good returns for these investors. So which is better, the Norway model or the Yale model? Well, the quick answer so far for sovereign wealth funds has been the Norway model. They've beat the markets most years. Okay, so this is where do they invest? The next few slides will show actually how they do invest. Not whether they should, but how they do. Very quickly, though, let me say that one of the problems you get into looking at sovereign wealth funds is you don't see 80% of the investments. At most, you see 20%. Those that are listed stocks or that are announced, or real estate. So this is just of what we can actually see. We've shown a little over $1.2 trillion identified. So out of 6 or 7 trillion, we don't see much. But of those, you can see that it's the equity has been, the investments have been going up, been going up. The amounts have been going down since 2008. But as I'll show you in the next slide, I think, this is from the, I had blocks around it. This is from our database. A couple things I want to point out here. First, these are the total value of the deals that we showed for these 4 funds. So it's Qatar, China, and the 2 Singaporean funds. That's $400 billion for those 2 funds. The investment, 1,000 investments, $400 billion. When they do make equity investments, the average is 16%. So when they make an equity investment, they buy 1/6 of the stock, paying an average of almost $500 million. These are not small investments. These are very large investments in companies buying a sizable amount of stock. And you can see by number, 3/4 are foreign, by value, 2/3 are foreign. This is the pattern that you see when you look at how sovereign wealth funds invest. They've increasing, whoa, that's not supposed to go that way. Can we? Well, I'll do it like this. What this shows, trust me, is that they've become much less risk averse, they've become much more risk averse over time. So they've increasingly done, if they're making equity, oh, well, I'll show you. Can we get that? What did I do? Let's see, maybe we'll just try this. No, we need to get it back. Okay. Well, what this is showing here, the slide, I'm a professional, I can make this work. They've increasingly become safe investments. If you go back to 2006, 7, 8, and then 2010, overwhelmingly, in fact, 2/3 of it was in financial, particularly 2007 and 8. Today, financial makes a very small part. They don't buy many bank stocks. So what they do buy is going to be increasingly real estate, which makes a lot of sense. That's part of the safe assets, risky assets. What it also shows in the slide that we're going to probably miss here is the holdings of the Norway fund. That Norway fund, the one fund, owns 1.3% of all the world's stock, 2.5% of Europe's. They own almost 1% of all bonds. This is a monster with a few hundred people on the staff. So this is a very unusual company, very large, professionally run. But again, it's a fund. And yeah, one more. This is the holdings of the fund. Thank you. I'm running a bit behind, so I won't belabor this. But if you think about it, if you have several $100 billion, you don't need the money now. And this is the first year, this year, Norway, for the first time, actually drew some money out of the fund. So you can make long-term, illiquid investments, because from finance theory and evidence, we know if you don't need liquidity, you're going to have a higher return buying illiquid assets. So they've been able to, because they're so big, they don't need liquidity, they don't need the money, they're able to make the kind of investments which finance theory and evidence shows give a longer return over time. They've beat the market most years. Not 2008, not this year, but most years Norway has in fact beat the market, beat their relevant benchmarks. Okay, now there we go. All right, so what I'll look at now, and we're making fairly good time, where should they invest? Some of it I've already hit. You don't want to invest, if you're a small country, you don't want to invest domestically. So you basically want to invest internationally. What industry should you invest in? Well, these have been looked at by different folks, and they don't really come to a conclusion except that you basically should invest abroad. And in our database, it's 94%. Another way we look at it over this time frame, 94% of all investments were abroad. So overwhelmingly, it's abroad. What industries? Well, also overwhelmingly, it is in OECD countries, rich, safe countries. The blue is OECD. What industries? You can see 2007, 8, 9, that is finance, the banking. By 2013, 14, and 15, the dark blue is real estate. If you need to soak up billions of dollars into investments, and you're politically sensitive in making your investments, real estate's perfect. Now, will that change with Brexit? Almost surely, because one of their favorite targets was London. So this is one of the other unexpected fallouts from the Brexit vote. They've also started divesting. They buy, but they also sell. And one of the things that's been happening in the last few years, particularly the last 2 years, is they've been selling quite a bit. This is what we can identify, 22 billion. Macroeconomic numbers say last year it was closer to 70 billion divested. This year maybe 100 billion will be divested. The reason they're staying constant assets is because of the returns. But in terms of net flows to sovereign wealth funds, those have stopped.
3 minutes?
Yes, okay. If it's 3 minutes, I'll go through this pretty quickly. This just shows they're very low cost. They basically, this is Norway, but increasingly most of them, they handle most of it internally, and the cost is, that's basis points. So it's 0.505% cost. The last one I'll look at then is, and I'll go straight to our study. What we did is basically we compared, this Review of Financial Studies paper, we compared sovereign wealth fund investments to private benchmarks, other private investments, and I'll go straight to the results here. You can see it in your slides. The key point is this slide here. What do we have? Sovereign wealth funds alone, they are positive. When they're announced, the stock price of the target goes up. If you take out Norway, which are very small investments, you take those out, it goes to 2.5%. So these are positive. They were, when they announce that they've bought stock in a company, this is a positive return. Problem is, the benchmark private is twice as big. It's very robust. There's a sovereign wealth fund discount. It is positive. The news is positive, but it's less than half as good as if it's a private investor. So the fact that you're a state-owned investment fund making cross-border investments is inevitably going to be controversial. And so the empirical evidence shows that it is negative. Okay, so how do we find out? What do we know? Well, first thing, sovereign wealth funds are big, 5, 7 trillion, but they're not particularly large or frightening. They're not taking over the world by any means. They're not homogeneous, but they do have common features. This is one of the most important. They're state-owned, and they make politicized capital allocations domestically. There's no evidence they do it in their international investments. Domestically, yes, but in their cross-border investments, no, they're not politically motivated. They're second best. If you could do this through private investors, it would be much better. It would be better received in the target market. So this is the second best solution. But I've become a bit more sympathetic to this over the years that I've been looking. Is there really an alternative to mobilizing wealth in these countries channeling it through the state. I'm not sure that there really is. So I'm almost through here. What is the problem? We don't know very much. There's so much that we don't see. So much of the data, 3/4 to 4/5 that we don't actually see. So we can't answer some of the most important questions. What should they be compared? We think we make a contribution by showing it compared to private investors. The key question, I'll end with this, and I'll end it almost as a question. Should certain countries adopt a sovereign wealth fund? Japan is the classic example. You have a very large public fund, pension fund. They're mooted to have a sovereign wealth fund. My opinion, it's a fairly balanced, but probably not. Should India? Certainly not. Should Saudi Arabia? Yes, but whether they can get there or not is another question. These are not going away. Sovereign wealth funds are going to be part of the financial architecture for a long time to come, and fascinating, and there's unfortunately much we do not know. So, thank you very much.